1976, Congress buried a single provision inside a 900-page tax reform bill that would have cost American banks and inherited fortunes billions of dollars every year. And by 1981, without a public vote, without a floor debate, that provision was gone. No explanation on record, no press conference. No one in Washington has ever explained who gave the order. The Tax Reform Act of 1976 was sold to the public as a cleanup bill. Closing loopholes, making the system fairer. Congress had been holding hearings for 3 years, and by the time Gerald Ford signed it in October, the law ran nearly 1,000 pages. Most Americans never read a word of it. Most journalists covered the surface changes, new brackets, new credits. But buried in Section 1023, deep in language almost no one would find, was something different, something that hadn't existed in the tax code before. A rule about what happens to wealth after you die, a rule that, if it had survived, would have changed everything. Before 1976, when someone died and left you $1 million portfolio stocks bought in the 1940s for $5,000, you inherited it tax-free. Not just free of estate tax if the estate was small enough. You inherited the gains themselves, the difference between what your grandfather paid and what it was worth the day he died, untouched, gone. No capital gains tax, no accounting. The IRS called it a stepped-up basis. The wealthy called it planning. What Section 1023 said was this: that ends now. Starting January 1, 1977, heirs would inherit not just the assets, they would inherit the original purchase price, the tax basis. Every dollar of appreciation since 1913 would follow the money into the next generation, and eventually someone would owe the government for it. The Congressional Budget Office estimated the rule would recover hundreds of billions in what had previously gone untaxed. Hundreds of billions. In 1976 dollars. The banks knew immediately. Within weeks of the bill's passage, the American Bankers Association, the U.S. Chamber of Commerce, and more than 40 lobbying groups filed formal objections. Their argument was practical. The record-keeping alone was impossible. How do you prove what your grandmother paid for farmland in 1932? Who tracks the cost basis on stock certificates from 1941? The compliance burden, they said, was unreasonable, and Congress agreed. Implementation was delayed by 1 year, then delayed again, and again. The rule that was supposed to take effect January 1, 1977, was still sitting in suspension 4 years later, waiting. And then in 1981, as part of the Economic Recovery Tax Act, the Reagan tax bill that got all the headlines, Section 1023 was quietly repealed. Carryover basis gone. Remember that number, 4 years, come back to it. Now watch what happens next. The IRS had actually begun preparing for the rule. Forms were drafted. Internal guidance was issued. The agency had spent 4 years and millions of dollars building the infrastructure to track inherited cost basis across every estate in the country. When Section 1023 was repealed, all of that work disappeared. Not archived, not published, not studied. The materials were quietly withdrawn, but here is what makes it impossible to explain away. In those same 4 years, 1977 to 1981, inherited wealth in the United States transferred at a pace economists had never measured before. Estates were moved, holdings were restructured, trusts were redrawn, and when the rule finally died, no audit followed, no congressional inquiry. No one asked what happened to the records from those 4 years. The assets that moved during the delay between the announcement and the repeal were never subject to the tax that was coming. And the people who moved them knew. They always know before you do. That is what the 4-year delay actually was. Not a compliance problem, not a record-keeping burden, a window. And the people who benefited from that window were the same people who lobbied to open it. The step-up in basis loophole, the one Section 1023 almost killed, still exists today. In 2023, the wealthiest estates in America passed an estimated $3 to $4 trillion to the next generation. Under current law, a significant portion of the capital gains embedded in those assets will never be taxed. They reset at death, exactly as they have since 1913. Congress has proposed closing the loophole at least 7 times since 1981. Each time, it has died in committee, or been stripped from a larger bill, or been replaced with a compromise so narrow it changed nothing. In 2021, the Biden administration proposed taxing unrealized gains at death directly. The provision was removed before the bill reached a floor vote. No member of Congress publicly explained why that specific provision was cut. The same institutions that killed Section 1023 in 1981, their successors, their money, their lobbyists, are still in the room. The room just has no windows anymore. So hold on to this. Section 1023 passed. It was law. It had a start date. And then it was gone, not because the math was wrong, not because a court struck it down, not because the public demanded it, because someone decided it would never be enforced. What no one has ever answered, what no one in 43 years has ever been made to answer, is who made that call.